battlefield zones. So mainly we're going to talk about zones. Levels versus zones. You guys have all heard of price levels before, right? Like the price, current price of what it is. So the price of the stock market is an extremely dynamic concept. So it changes all the time. It has so many factors play into it. There are so many ways to analyze it. So it's very, very dynamic. And this classic concept of individual thin price lines, like these individual lines or candlestick, that also these lines. So these classic lines, like you guys see, that are horizontal. So these classic concept of individual lines that represent support and resistance is often very not as helpful to traders who fail to using these to assess correctly of the stock market. So basically these lines, they are helpful, but many traders fail to use them. So that's why today we are recommending to use the support and resistance zones to get a better explanation. So in this image, you can see that it shows a price chart with conventional price lines of support and resistance line. So last time we talked about support and resistance line, and these are support and resistance lines. So the horizontal lines that we draw across to analyze a specific chart. And as you can see here, these are the conventional lines. At a first glance, this looks very promising. You can see a lot of information from this chart, but the impact and the reversal points can be seen clearly. And as you can see here, if you see a chart like this, you can tell a lot of information. You can tell a lot of information. You can think, oh, this is very detailed. It can be very helpful. But on a closer inspection, it becomes clear that price lines are mostly not respected at all price trends to either miss or shoot these lines. So for example, if I draw this line, right? Actually, no, that's not. If I draw this line and I'm trying to predict, so right here, for example, I don't know any of these information and I'm right here and I'm trying to predict where the stock market is going right here. So back to the support line that if we were to draw from here. So if we were to connect 1 point, 2 point, 3 point, 4 point, and then 4 points. Last time we said 3 points confirm a support line. And if it does go below this line, it can indicate a downward trend. So at this point, if we were to stay above this line, we can be a trend trader, right? But if we were to go below this line, we're expecting a downward trend. Now from this line, we can see that it is true. And we can use this line to try to predict our next move. So if it went below this line, and we will call this a retest. So this sometimes works, but how would we know? Should we draw this line, or should we draw this line, or should we draw this line? All of which connect 3 points. So this is where it leads to a very, very great frustration for true traders who either misses an opportunity to place a trade because they drew the wrong line, or either their points hit and they often just estimate the exact points. So, and if they enter too early or enter too late or get too frustrated in the process, that can cause a lot of financial loss. So overall, using support and resistance line, it's very, very not helpful for people who are not as mentally experienced or prepared for the fluctuations of the price dynamic in the stock market. So when we go to the another image, so if we look at a closer inspection, you notice that the price rarely respects the lines exactly and often overshoots or reverse early. So as you can see, if we look at this one, right, it doesn't exactly hit the line. So if it doesn't hit the line exactly, should I enter or should I not? Also right here, it exceeded the lines a little bit. Now, should I enter or should I not? Should I wait a little bit or should I not? Also right here, it went above the line a little bit, but do you guys see what I mean? And right here, it's not hitting the line exactly. And right here, we have a perfect hit. But right here, we don't have perfect hits. So, and also look, it went below the line. So these are the things that cause so much frustration in the stock market trading in the battlefield. So that's why today we're going to be learning about zones, and let alone we're going to, we already learned about levels. And because we noticed so many flaws about the levels, we're going to talk about zones today. But understanding what levels are is a very important basic understanding before we move into the zones. So in this image shows that the next one. So in this image is a better demonstration when we draw the zones. So in this image shows that traders are better advised to mark the support and resistance area using zones to increase the value of the concepts. So it expands your margin of error. It expands your margin of error, basically. That's what it is. So the zones may appear to be very broad at first glance, but a trader will be very effectively be trading if they can use the zones correctly. And today we're going to learn about how to use it, how to draw it, and how to use it effectively. So this procedure is also called the multi-time frame analysis. So a lot of people, instead of zones, they will say, they will call this multi-time frame analysis. So that's another name for zones, and which is used to identify important price levels in the higher time frames, the lower time frames. So time frames, what we're talking about is used by day, the time frame you select. If you select 1 day or 1 minute or 3 minutes or 5 minutes or 1 month. So these zones are also used differently according to different time frames. So we're also going to be learning about that today. And in this case, the trader will be using these zones that we identified, that we will be identifying. So as you can see here, this is the same chart as before, but instead of price levels, we're using zones. So look, it's the same chart, but we expanded the margin of error so that every price point hits within the zones, and we can wait until it exit or leave the zones to make the most accurate prediction that reduces our risk. Okay, so let's start learning how to draw the zones. Supply and demand zones. Can anyone remind me what supply and demands are in economics when we learned it?
Demand is basically that people want something, and supply is the thing that the factories make or like the companies make.
Yes, that is 100% correct. So trading, right? Trading is I buy something, you sell something. And that is why the stock market is called the stock market, because the market is where the trade occurs. So what are some conditions for trade to occur? There has to be supply, there has to demand, there has to be buyers, there has to be sellers. So in the case of the stock market, supply and demand, the supply are the people who are selling the stock, they're supplying to the market. And the people who are buying the stock, they're the demand. I demand this, I want this, I'm the consumer of the stock. So that's what demand and supply are. So the concept of supply and demand zones is very similar to that of support and resistance. And however, there are few differences as well as which enable the traders to both use the concepts simultaneously with finding the high impact price areas. So instead of support and resistance lines, we're now finding areas. So the idea behind supply and demand zones. So supply and demand zones are usually relatively narrow price corridors in which the price has initially paused briefly before it exploded into one direction. So as you can see here, in these supply and demand zones, the ratio between the buyers and sellers splits so rapidly that the price moves away from these rooms in an extremely impulsive way. So as you can see, these sharp changes, this indicates a very impulsive change in the supply and demand shifts. So in this image, it demonstrates the behavior of supply and demand zones specifically very nicely. For example, if there is a sudden strong upward breakout in the zone, zone 1, let's say this one. So zone 1 right here. So there is a suddenly explosive breakout in the demand zones. Demand meaning the buyers, right? The buyers are very strong right here. So it shows that the buyers suddenly absorb all the selling interest. This imbalance usually occurs in a valid demand zone without notice one moment to the other, which confirms that the buying interest in this zone has accumulated in a flash that all sellers withdraw all at once. So this scenario happens when all the sellers leaves all at the same time and buyers all enter at the same time. But because people are buying and selling at the exact same time, it is really hard to predict if we will have a relatively stable growth or stable downward trend. You can see we talked about the angles before, right? So this will be a very steep upward trend, a relatively more stable upward trend. So as you can see here, the angle here is almost, we got 90 degrees right here. So this is a very sharp increase, and I think it's relatively harder to predict this from a support and resistance line, because those are usually used for a more like right here, right? If we were to draw a support line right here, and if it go below our support line, we can expect a little bit of a downward trend, and then a new support line right here, although we don't want to cut through candlesticks. Okay, so if the price enters such a demand zone again as zone X, which is right here, it enters again as zone X, where the buying interest still exists, but probably not because all the buyers managed to enter during the first move, but because everyone sell at the same time and then bought at the same time. That's how this occurs. So traders who follow the concept of demand zones will therefore look for clues and other influence factors in the zones while trading for the next upward movement. So how do I explain this? So demand zones is like in which the demand is way higher than the supply. In other words, the buying interest is way higher than the selling interest. So these two occurred in these two scenarios where it entered a demand zone. It's like the buyers, it's greatly greater than the sellers. So this image at price 0.1, we suddenly see a very strong explosive breakout, which indicates a significant overweight of buyers. And we call this a demand zone. I'm just repeating this concept over and over again. So if the price fall back into this zone, the leftover buying interest is picked up and the price can start a new upward trend. So we notice a supply zone, a demand zone, and then the price fall back into this price point. So this is where we can expect another spike of a demand zone, because all the other buyers who are potentially interested at this price point are regained right here. Now, does that make sense? So people,
yeah, I understand.
Yes.
Okay. I just want to make sure you guys understand. So first of all, people are entering right here. Now, if we return back to the similar point, we can expect a similar movement. That's basically the idea. Okay, so now that we understand what demand zones are, similar with supply zone, right? People, when they reach, we think reversely, when they reach to this price point, very high, right? People started suddenly selling, and then it returned back to the almost similar price point. We're expecting another fall. But now you might argue, okay, so if we reach here again, why didn't it fall? It's because, look, of course, there are some retests that it's going to fall a little bit. But in the long-term growth, when we learned about business cycle, in the long term, it's a long-term growth. It's always going to be going up, but then there's going to be fluctuations in between. So this is what a business cycle looks like in macroeconomics. So we want to expect the same for the stock market, that it's not always going to be remain on the same price level forever. Okay, so now let's learn about drawing the supply and demand. So the formatting. So there are several methods to identify supply and demand on the charts. So the first one, moderate volatility. So volatility is the degree in which it's like this, right? Is it volatile? I can't pronounce this word, but basically what this is good supply and demand zones are usually relatively narrow and the price does not fluctuate strongly during the short consolidation phases. So this indicates a very proper balance between the buyer and sellers. Okay, so I just explained what the first concept is. Let me test you guys. So would this image be considered moderate volatility? No, because the chart moves. Oh, yes. Okay. So everyone who said no, you're correct. So the first way to draw supply and demand zones is to know that one factor is moderate volatility. When you hear traders say, oh, the market supply and demand are pretty even today, what does that mean? That means that the market is not volatile. Volatile is very moderate volatility. So it's not going up, down, up, down, up, down, or have these sharp increases. It would mostly look like this. So this section, we consider relatively volatile, moderate volatility. All right, so that's what the first one is. The second factor is called timely breakouts. So good zones should not wait too long for the breakout, and the consolidation phases are often very short. So the underlying idea is that the buying and selling interests suddenly tilt, but the imbalance out is not too long in coming. So okay, so in this image, it shows a newly created supply area on the left. So what does supply area mean? That means people are selling, right? That means we're going down. So this is a supply area. And the price did not spend much time during the initial consolidation phase of going sideways, and breakout was extremely strong. So the time right here was relatively little, and the breakout was relatively strong. The next time the price enters the zone, it leads to a new sell-off. So the X mark of the re-entry into the supply zone. So right here. So what it's saying, basically right here, right? Where exactly would you guys say that it started entering the supply zone? I will argue right here, right? Probably right here is where we start entering the supply zone, a very stable downward supply zone. So now, because we are hitting back to this point again, usually a very safe trader would, oh, this image is very hard to see. So right here, there is a zone right here. Someone drew, there is a supply zone drawn right here. I don't know if you guys can see this. So this is called a supply zone. And we are assuming that the supply started right here. Because if we were to bring back our previous knowledge on trend reversals, right here it formed a lower, right here is where it formed a lower low and a lower high. This confirms a trend reversal. So do you guys still remember what lower lows and lower highs are? So lower lows is a low that is lower than the previous. Lower high, that is a high that is lower than the previous high. So a lower low and a lower high confirms a price trend reversal. So this is where we will mark the supply zone. And we will extend the supply zone all the way until that it hits it again. So right here on the X, it enters the supply zone. That means at a similar price point where the previous sellers started selling, it's going to happen again. So this is where supply zone and the demand zone comes in very useful. So a timely breakout basically says that it's relatively very matching in the previous supply zone. So if I were to summarize this image again, basically the supply zones on the left extends over only 2 candlesticks before the price breakout. So only 2 times kind of before it breakouts again, enter a new supply zone. So the third one is called strong breakouts. Now let's look at these two. Would you guys say these are, so first choice 1 is moderate volatility. Second is very volatile. 1 or 2? Yes, it is extremely volatile. It is number 2 and it's not moderate. But this is where it gets really hard because, okay, I'll actually show you guys how this actually works. For example, if let's go to 1 day. Let's go 4 hours. So how we want to determine if it's volatile or not is not by purely looking at it, as I was teaching you guys earlier. It's by comparing it to the previous day or your previous trading period. For example, if you're a day trader, you want to compare it to the previous day. If you're a swing trader, for example, you trade once a month or once every 3 months, you want to compare it to the previous month. For example, let me draw some lines here. So look. So a brush, steel brush. So if we were to look at this area, right, and we compare it with this area, we would say that this area is more volatile than this area because this area is a very stable. There's not much change. But right here, you can see the up, down, the green and red candlestick interrelating with each other. So why don't we try to identify some supply and demand zones? This is actually, it's going to take some time to look at it. So why don't you guys take a look, if we take a look, and I will also take a look and see where we can define these zones.
I would say I see a demand zone between like the 18th of February to like the 15th of March.
So this is a supply zone. Basically what you're saying is when it hits this price point, we see an increase and then there are some fluctuations of going down and we hit this zone again and then there is an increase. I agree with that. I think this is a good way to draw it. But the thing is, actually, I think this is a good one to draw because the reason why we can draw this is because we see a pretty sharp increase right here compared to everything else. So what you want to do is you want to compare to the before, right? If you're right here and you don't know what price is going to be next, how am I supposed to draw this? Because you already see the whole chart. Drawing this right now is just for practice, but in the real world, there's no use. So how can we draw this to predict the next move? We want to compare it to the previous. Okay. So I think this is oh, this supply zone is actually, you can extend this. Hold on. All the way here.
It works.
Yeah. So yes. So
yeah, that's better.
Yeah, if you can draw this zone, you can predict the next one. If it hits this zone again, you can predict this upward trend, right? And you can make a lot of money going up. And because the market is always growing, we're going to assume that it's not going to hit the zone again. But if we were to extend the zone all the way over there and it comes back, this is a very good entry point. So Zara, great explanation on that one. Let's see, look at the supply zone. So it is a lower high if you compare it to the previous high. So, okay, so let me get my marker. So we are seeing, so you're saying that this right here is a lower high, and this is a higher high. So you're comparing these two. Also, you can see that this candlestick has a upside wing, well, which can mean that the sellers are strong here, and finally the level broke later and acted as a support. So right now we're looking for demand zones, when demands are going to start. Okay, so I think that's a very good one. So let's draw the support line if we were to. I would start right here going up like this, but the support line isn't very always accurate because we know before that it go above or below a little bit. That's why a zone will be very useful. So, okay. So we are using right here. So obviously you can see it hit 3 times and it's all within the zone. So you definitely can keep this in mind as a pattern. So if the stock ever goes in this price range, go back down here, we can expect a bounce. But if we were to look at a longer trend, like it depends on how long you're holding the stock, right? So maybe when it gets to this point, it will retest a little bit. But if we were to look at more long term, if there's no significant changes in the quarter reports of the specific company, but this is just SBY, so it's not a specific company. Yeah, so it depends. Okay, how much you want to zoom in and how much you want to zoom out really depends on how long you're holding the stock. So right here, I'm already so zoomed out to months. So if I were to do these type of analysis, it would be, I will be holding it for several months. And these little fluctuations wouldn't really affect me. So if I were to be a trend trader, I will use this as a upward trend, and every time it hits line, I will use it as an entry point. So I will expect this to hit the line again. But for more day trading purposes, I have several screenshots of the analysis. So let me pull them up. I'll share it with you guys. Screenshots. Okay, I'll find them for next class when we wrap up the technical analysis. But again, just remember, however much you zoom in or zoom out really depends on however long you're trading. Okay, so we spent a long time on this. Let me go back to our presentation. All right, so strong breakouts. This is what we call strong breakouts. These strong breakouts are very useful for supply and demand zones. All right, let's move a little faster. Okay, so going back, the fourth one is order observation. So what that is basically the concept of which we have learned in connection with supply and resistance line. It says that the price level can be weakened with each contact point. So every time a contact with your support line or your resistance line, it becomes weaker than previously. So therefore, only the first or the most second entry point of supply and demand zone can be traded. So you can't be like, oh, I'm drawing a long support line. Every single point it's going to hit and it's going to go back. No, the pattern is going to change. So only the first or second point after your confirmed support line or supply demand zones can be used to be traded to avoid any misunderstanding of these patterns. And the fifth one is spring formation. So the spring formation, this confluence factor cannot always be found in supply and demand zones, but it can improve the quality of such zones. So a spring formation shows a failed breakout attempt, which is immediately reversed. For example, it hit the support line, it hit the resistance line, but they exceeded it, but then immediately it's reversed, and then it doesn't shoot out as a lot of traders would expect. And that's why a zone will be very useful, because you widen your margin of error, you play it safer. That's basically what it is. Okay, so that does wrap up our class today. Yeah, hope you guys absorb all the information today. Thank you guys so much for coming. See you next time. Bye.
Bye.